What's up guys, in today's video we're going to be talking about the huge gains in which we've seen in the stock market over the course of the past 12 months, and in light of all of this bullish momentum, we're also going to be talking about when the best time to actually take your profits is. We'll talk about some different investing principles when it comes to actually looking to sell a position, as it's always important to have in the back of your mind an exit strategy in order to maximize the gains in which you've made. But before I do so guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video guys, really helps out the channel. With that being said, let's dive straight into it. So let's talk about global financial markets, because we've seen green days upon green days with both the European as well as the US stock market making huge gains over the course of the past few weeks. And that's partially down to the vaccine rollouts as well as restrictions being lifted, as well as what's being labelled as the new normal, which is just upon the horizon. In actual fact, the US stock market has hit all-time highs once again after making significant gains from the pandemic-driven market crash during March of 2020. If you'd invested into an S&P500 Index fund during this time and managed to actually capitalize on the absolute lows of the market, assuming you're an absolute market wizard and can time the market absolutely perfectly, you'd have made to the tune of 77% return on investment. Now, to put that into context, the average rates of return for the S&P 500 is roughly about 9 or 10% per year on average over the course of the past 100 years, which means that using the rule of 72, you would double your money every 8 to 10 years, assuming this return on investment. However, with a 77% return on investment, the time it takes to double your money significantly reduces. And in actual fact, if we could keep up this kind of momentum, you would double your money every 1.2 years. Now that's pretty crazy to think about, and absolutely anybody who put their money into a kind of broader market index fund pretty much at any time over the course of the past 12 months would certainly have made some money during that period. On a similar note, I've also got to throw this in as well for additional context. If you would have also invested into many of the top cryptocurrencies around like Bitcoin, Ethereum or XRP, you would also been heavily in the green over the course of the past 12 months, with the likes of Bitcoin having respective gains of 705%, Ethereum having gains of 1,199%, and with XRP your gains would have been 410%. So whether you've been invested into the cryptocurrency market, the stock market, or a mixture of the two, the chances are you've probably made money over the course of the past 12 months. And this has certainly been helped by and large by big quantitative easing programs over in the United States, which has meant that over 75% of the total US money supply has actually been created over the course of the past 12 months alone, as well as stimulus packages, as well as the furlough scheme, which has seen a lot of retail investors start to put their money into some of the most popular brokerage apps like Robinhood, who have seen user growth of over 30% during 2020 to now over 13 million, along with Trading 212 over here in the UK, who saw their client base go from 400,000 to over 1.4 million clients over the course of 2020, which inevitably resulted in them having to close down their applications because their back-end servers weren't sufficient enough to support the volume of new clients, along with the general sentiment that there is an overall optimism floating around, specifically after US job growth reports by the Labour Department when they reported their non-farm payrolls, or NFP for short, which for those of you guys who don't know is just one of their core employment metrics over in the United States, which saw an increase by 916,000 during March, which is the highest since August 2020, resulting in a 6% unemployment rate, which is down from the record highs of nearly 15% back in March last year. So with the stock market and our investment portfolios at absolutely all-time highs, and with lots of conflicting economic indicators floating around, as well as the unknown of what's going to happen with the pandemic, we could potentially see a third wave of the virus floating around. When is the best time to actually cash in some of the gains in which you've made and actually realize the benefits of being an investor? Well, in terms of market timing, I don't know, and nobody else out there knows when the best time to actually sell stocks is. So in light of this, I thought I'd put together a few general principles that you could potentially look to follow, whether that's you looking to sell a stock now or at some point in the future. Principle number one is to sell when prices rise dramatically. Now that's certainly a subjective principle to start with, but hopefully it will help try and take some of the emotion out of investing if you kind of look to set price targets before you actually invest into an asset class. Now what I mean by that is, let's just pick Tesla as an example, which is trading today at $688 per share. At what price point would you be comfortable to take some money out of your position? Would it be $1,000 per share, $1,500 per share, $3,000 per share, or $10,000 per share. I think it's really important to have realistic expectations on the future price performance of a stock and to kind of be mindful of that before you actually look to invest into it. Similarly, if you have an objective price target in mind, it can be a bit of an indication to actually now think, okay, objectively, I should probably start to take some of my profit off the table, even whether that's just clawing back the principal in which you invested, or even taking the whole profits from the position and reinvesting elsewhere. Because as the old saying goes, nobody ever goes broke booking a profit. Principle number 2 is to sell when a stock becomes too heavily weighted within your portfolio. Now, I guess you could say that this links into principle number 1, but let's say the stock in which you've invested in dramatically rises in value and it becomes an ever greater portion as a percentage of your overall investment portfolio. And I'm sure, as some of you guys will probably remember, here is the kind of asset allocation in which I'm actually working towards within my investment portfolio currently. Now, let's say the price of Tesla's stock absolutely skyrockets in value and it becomes a huge overall portion of my overall investment portfolio. In this instance, I may look to sell a small proportion of my Tesla position in order to reinvest back into some of the stocks in order to rebalance my investment portfolio. All this means is that I'm taking money out of one stock and moving it into that of another. This in essence mitigates the risk that one single stock could massively dictate the overall value of my portfolio, whether it's booming or busting. So because of this, you may want to think about rebalancing your portfolio every so often. Principle number 3 is to sell when there is better potential elsewhere. Now, within my own investment portfolio, I have a mixture of winners and losers within it, and I'm pretty committed to all of the stocks in which I invested into based on their future growth potential. However, if you find stocks within your own investment portfolio that aren't performing to your expectations, it may be wise to consider investing your money elsewhere. This could be a stock with better earnings growth rates, or even a better dividend yield, or perhaps a different asset class altogether. And as with anything in life, obviously there has to be a balance. What you don't want to have is the shiny ball syndrome where you invest in one hot stock, it doesn't quite play out in the short term, so you sell it and then look for another, and whilst doing that, you're forever chasing your tail. Due to this, if you know that the stock in which you invested into has absolutely run its course, and you know that there is a better investment opportunity elsewhere, well, have the confidence in yourself and the due diligence in which you've done to invest in that better opportunity. Principle number 4 is to sell when a company's long-term profitability is going down. Profitability is one of the key performance metrics that allows stock prices to rise. From a recent study of stock prices between 1988 and 2017, it's clear to see that the earnings per share and the price of a stock market index is very closely correlated. In essence, the higher the earnings per share, the higher the stock prices will go. So when you see the opposite of this trend taking place and the earnings per share of the stock in which you've invested into is on the long-term downward trajectory, it's probably wise to take your money and run. Principle number 5 is to sell when a stock doesn't play out as expected. As the old saying goes, you must know when to hold and when to fold. We've seen over the course of this year specifically just how dedicated people are to specific courses, and they will hold their stocks through thick and thin, regardless of the fact that they're losing a hell of a lot of money whilst doing so. However, I think it's absolutely critical for long-term investing success to know when to cut your losses and run. Because remember, not every investment can be a good investment. We are all human at the end of the day, and mistakes will happen. Even the best stock market investors have lost money in the stock market. The most important thing here is to just make sure that your winners are bigger than your losers. But with that comes a self-awareness to know when the best time to sell a stock is. And I guess that links back into principle number 1, by not only knowing that kind of upside price target at which point you would be prepared to take your profits off the table, but it's also worthwhile acknowledging if the stock in which you invested in doesn't play out, what price point would you be prepared to hold to before it becomes too uncomfortable based on the losses in which you'd be making. So they are my 5 principles, guys. Be sure to let me know what some of your investing tips and overall principles are down in the comment section below. If you enjoyed the video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.